Will I ever buy a house? Believe it or not, the single biggest financial anxiety for anyone under 40 right now isn't inflation, isn't recession, isn't even retirement. It's a much simpler question. Am I ever going to be able to buy a place to live? We have a full series on Patreon about real estate, leverage, and how to actually plan around housing in this environment. But today, we focus on why an entire generation has become genuinely convinced that the door has closed behind them, what the numbers actually say, what's driving this, and what the realistic paths forward look like. If you watch one video today, make it this one. The numbers. Nobody wants to say out loud. Let's start with the math, because this isn't a feeling, it's arithmetic. In the United States in 1985, the median home cost roughly 3 times the median household income. By 2000, that ratio had risen to about 4. Today, it sits at roughly 7. So a house that used to take 3 years of gross income to buy now takes 7. The asset hasn't changed, the math has. In the Eurozone, the picture is even more uneven. Berlin, Amsterdam, Lisbon, Madrid have seen prices double or more in the last decade. Paris and Munich are among the least affordable cities in the world relative to local wages. France's price-to-income ratio in major cities now sits around 8 to 10. In Switzerland, prices in Zurich and Geneva have decoupled from local incomes to such a degree that even high earners struggle to qualify for mortgages without family equity. This is not a perception problem. The ratios have genuinely doubled in a single generation. The mortgage rate whiplash. Now, layer on the rates. From 2009 to 2021, mortgage rates across the developed world were anchored near historical lows. In the US, you could lock in a 30-year fixed mortgage below 3%. In the Eurozone, fixed rates dropped under 2% in some markets. Swiss mortgages flirted with 1%, with 1. Then 2022 happened. Inflation surged, central banks hiked aggressively, and mortgage rates roughly tripled in 18 months. US 30-year rates peaked above 7%. Eurozone fixed mortgages climbed past 4%. Swiss rates doubled. Here's why that matters. A $500,000 mortgage at 3% costs about $2,100 per month. The same $500,000 mortgage at 7% costs $3,330. Same loan, same property, when $200 more per month. That's $14,000 per year of additional cash flow just for borrowing the same amount. So, young buyers got hit with 2 punches at once. Prices stayed elevated from the cheap money era, and then financing costs doubled or tripled. Affordability collapsed. Why prices never really fell. You'd expect that when rates spiked, prices would crash. They mostly didn't. Why? First, supply. After the 2008 crisis, home builders pulled back dramatically. The US underbuilt housing for over a decade. Many European countries have similar shortages, especially in their major cities. You can't fix a 15-year supply gap in 18 months. Second, the lock-in effect. Existing homeowners who refinanced at 3% are not selling into a 6% market unless they absolutely have to. Inventory dried up. Sellers stopped selling. Prices stayed firm even as transaction volume collapsed. Third, demographics. Millennials are the largest generation in US history, and they're now in their prime household formation years. Demand didn't disappear. It just got pushed into rentals. Fourth, monetary aftershock. We've covered this in our currency and inflation episodes. Real assets, including real estate, held up because investors fled into things that central banks can't print. What it looks like in practice. So, what does the squeeze look like for a real person? Roughly this. To buy a $500,000 house in 2026, in most major markets, you need somewhere between $50,000 and $100,000 in down payment, plus enough income to qualify at current rates, which typically means a household income of $130,000 to $160,000. 20 years ago, the same purchase would have required maybe $25,000 down and a household income closer to $70,000. So the threshold to enter the market has roughly doubled, while real wages, as we've discussed, have barely moved. This is why the conversation has become generational. It's not that young people are bad with money, the hurdle has objectively risen. The path forward. So, is the answer simply give up? No, there are real strategies, but they require honesty about the new reality. Geography. The expensive cities are not the only cities. Mid-sized markets, secondary metros, and entire regions still have price-to-income ratios closer to historical norms. Mobility is the cheapest form of leverage. Time horizon. Buying right at peak rates locks in pain. But mortgages can often be refinanced when rates drop. The price you pay for the property is permanent. The interest rate is not. Smaller starting properties. The starter home tradition is back. Trying to buy your forever home as your first home is what's broken, not the housing market itself. Cross-border thinking. As we covered in the real estate episode, where you buy is also a currency decision. Some markets are structurally more accessible to young buyers and not always the ones you'd expect. Family equity. This is uncomfortable, but real. Generational wealth transfer is increasingly the difference between buyers and renters in major cities. Talking about it openly with parents and grandparents is no longer optional in many markets. The bigger picture, the honest read is this. The 1990 deal, buy a house in your late 20s on a single income, is gone in most expensive cities, and it's not coming back without a major correction. But home ownership itself is not gone. It has become a longer, more deliberate process that requires planning the way previous generations didn't have to. That's not fair. It's just the situation. If this topic resonates with you, we've built a full educational series on Patreon covering real estate strategy, mortgage planning, leverage, currencies, and the practical decisions younger households actually face. Link is in the description. Subscribe to the channel, share this with someone who's been told they're just not trying hard enough, and I'll see you in the next episode.